Well, good afternoon. Happy Friday, August the 19th. Mark Milam here, coming to you with this week's interest rate summary and market update. What is happening with our friends across the pond? Because that is telling the tale for how we've been impacted here in this country in terms of interest rates over the past week and really over the past 3 weeks. You would have thought, with all of the relatively tame inflation data that we've gotten here in the United States since August began, that interest rates would be improving. The opposite is actually happening, and we're getting a little bit of a repeat of what happened in June now as we move through August. Now we're at August the 19th. July, we got a good respite. We saw interest rates moderate, even improve on a lot of note rates, but here in August, we've started to see them deteriorate. In fact, in the past 5 business days, interest rates have risen at least an eighth, maybe a quarter of a point, depending upon the note rate that you're looking at. So why is that happening exactly? Well, let's take a quick look here. You can see ever since August the 2nd, we've been on this steady sell-off with mortgage-backed securities right up to today, August 19th, and these red days are bad days. That means the securities are selling off, interest rates are going up. Why is that happening? Well, let's take a look at a little bit of the economic data here in the United States, and you can see that the initial jobless claims came in at 250,000 in the past 30 days versus an estimate of 265,000. It's not really that big of a miss. That certainly wouldn't be the catalyst for the type of sell-off that we've seen. And if you go back and look at the United States data as it pertains to inflation over the past 3 weeks, pretty good, not bad at all, coming in under expectations. And really, we hadn't seen this all the way up until August of this year. We've been beating expectations, so nice to come in under expectations. But here's the crux of it. European inflation now hitting a 25-year high driven by energy spike. Of course, the conflict in the Ukraine affecting the entire globe, but none more affected than Europe. And unfortunately, we live in a very interconnected world. So interest rates rising so dramatically in Europe and in the UK is always going to have an effect on the United States. In other words, traders are thinking, are we really past our inflation highs, or have we just seen a little bit of fool's gold, a little bit of a plateau before we hit the next spike in inflation? And the data will tell us, but there's a fear that we're not out of the woods yet. And if you go back and look at some of these numbers, it's really eye-popping. UK inflation topping 10%, underlining a gloomy outlook for Europe. And then this is the one that'll really grab your attention. Record jump in German producer prices. So Germany just reported this morning a 37.2% increase, year-over-year increase in inflation for producer prices. That's the biggest rise on record since 1949. All of that giving credence to traders' concerns that are we really past the worst of inflation? And so long as this conflict in the Ukraine drags on, and now we're starting to hear news about Crimea and Crimea being involved in it, so long as all of that energy-rich area of the world is embroiled in a conflict, we're going to have these types of upsets. We're going to have these types of uncertainties where we're not really sure if we're out of the woods yet. In the meantime, if I can be of any service to you, please don't hesitate to reach out. Mark.milam@highlandmtg.com. Have a good weekend.